Welcome to Taking Stock for the week ending the 8th of April 2022. Joining me today is our Senior Equities Analyst, Jason Yin, to string to your thing share market. Welcome, Jason. I can't believe Easter is on our doorstep.
Yeah, thanks for having me, Kien. Are you doing anything with the family over Easter?
Good question, Jason. I'll be spending some time with the kids and also keeping a close eye on the amount of chocolate they will be eating. But let's turn our attention to the markets, which has been holding up quite well this week. But we want to remind investors not to be too complacent and really keep risk management as part of your investment strategy. So this week, we want to look at the importance of assessing financial health in the current operating environment. Since the emergence of COVID, we've seen a decline in the number of corporate insolvencies in Australia, even though the economy went through a technical recession and lengthy statewide lockdowns. This trend in the number of bankruptcies is shown by the chart on screen. As you can see, in the last 2 years, there's been an average 50% drop in the number of insolvencies. And the reason for this has been a mix of factors that has allowed marginal and struggling companies to defer the onset of administrators. These include government stimulus and support packages such as JobKeeper, bank interest deferrals, insolvency trading relief, and more leniency from the ATO.
I think conditions are also starting to normalize as well, Kien. The US Fed ended its asset purchases program last month and they lifted interest rates by 0.25%. The market's also forecasting 6 additional US rate lifts for the remainder of this year. Meanwhile, the Australian RBA is also hawkish and they signal that Aussie interest rates could lift as early as June if the inflation data remains elevated.
That's right, Jace. And rising interest rates really means that the cost of debt will increase and put further pressure on companies that have stretched balance sheets or slim profit margins. And the chart on screen by IBISWorld shows the annual change in business bankruptcies over time. As you can see, it's currently suggesting that the number of business-related bankruptcies are expected to grow by 50% this year as the so-called zombie companies face higher debt costs. And zombie companies are those companies with a lot of debt and are marginally surviving due to government support, Jace.
Yeah, there's also supply chain disruptions that we continue to see, and it remains quite prevalent. Higher raw material costs and labor costs, they're impacting a number of industries, including retail, manufacturing, tourism, and construction. And you can see some of these industries on screen right now. Investors should also be mindful that these active risks during the stock selection process. For example, we removed Adairs from our star growth universe on lower earnings expectations, but we kept the stock in our star income universe because its free cash flow is forecast to remain well above expected dividend payments, thus its ability to sustain the gross dividend yield of above 9%. Capital-intensive industries such as construction companies, which have significant debts and locked-in contracts, now they're also at risk as well. And this was evident in the recent collapse of building company ProBuild in Australia and also Chinese developer Evergrande.
Yeah, and although the weak sentiment does appear to have been captured in our star growth stock, James Hardie, we want to remind investors that it is a producer of fibre cement products for building construction, and it's not a contractor or developer itself. This is why James Hardie recorded positive earnings revisions over the last 3 months despite negative share price sentiment on the stock. So for some investors, this could mean opportunity.
Yeah, also over the last month, we've actually recorded 2 companies that went into administration. The first one is PharmaForce, which is an analytics company that services the pharmaceutical sector. Now, this company went into administration due to a distressed balance sheet with liabilities exceeding its asset base. Cash flows also dried up, and that led to its demise. The next company is IQ3, which is a corporate finance and advisory firm helping the life sciences industry. The company had significant debt and no cash flows, so the probability of insolvency was rather high.
Okay, let's now turn our attention to some star stock highlights. Earlier the week, wealth management firm Perpetual, they lobbed a takeover proposal to ASX-listed fund manager Pendal Group. While the deal is pending approval, the rationale behind the takeover is to help Perpetual expand its funds management business and allay the competitive pressures of the popularity of passive investment strategies. Since the start of 2020, Perpetual's growth initiatives have centered around the acquisition of global fund managers, starting with ESG specialist Trillium in January 2020 and the US-based global investment manager Barrel Hanley in July 2020.
So, with the potential addition of Pendle Group, Perpetual's funds under management will more than double from 103 to $235 billion. Furthermore, the deal should create a leading global asset manager with improved scalability and a vast distribution network. Meanwhile, cost synergies from the merger, currently estimated to be $50 million per annum, should help drive earnings growth and also net profit margins as well.
However, while the earnings outlook post the merger appears attractive, the dilutive impact from share issues and also the timing of the acquisition could mean that Perpetual may not meet Lincoln's growth hurdles if the deal goes through.
Additionally, Ken, the group will also become heavily weighted towards equity market performance due to a change in earnings mix, and this removes the current diversification benefits that Perpetual receives from its more stable revenue streams from its financial advisory and debt market services. We will be monitoring the outcome of this merger, and if it is successful, a more detailed analyst commentary will be released.
Also, for income investors, at its interim results in February, Telstra announced a network sharing agreement with TPG Telecom for regional areas, where TPG will be leasing Telstra's regional mobile assets to expand its current 4G coverage. In exchange, though, Telstra will receive a fee revenue of around $1.6 to $1.8 billion per annum, representing around 7% of Telstra's total revenue.
So, with minimum overheads and overhead expenses attached to this deal, we feel the additional revenue will likely expand the company's net profit margins. And this is exemplified by Telstra's earnings revisions, which has lifted by over 4% over the last 3 months. However, FY22 earnings growth remained under pressure, and this is from lack of international roaming revenue, cessation of the one-off NBN receipts in FY22.
Yeah, but positively, Jason, earnings are expected to recover strongly in financial year 23 from rising roaming revenue and mobile usage. Hence why we believe the gross dividend yield of around 5.8% that is sustainable despite the expectations for the payout ratio to rise to around 112% this year. Telstra continues to generate free cash flow that is well above expected dividend payments of 16 cents per share.
Yeah, well said, Ken. Over to the corporate calendar this week. No star stocks are expected to report or go ex-dividend. In terms of technical alerts, for highly trend-sensitive investors utilizing the SD Max, which is the Stock Doctor moving average crossover, we're pleased to see bullish signals come for WiseTech, Woolworths, Nine Entertainment, Hansen Technology, CSR, and Objective Corporation. Additionally, Objective Corporation also issued a re-entry on the SD30 TSR, which is Stock Doctor's 30% stop loss from its recent highs or gains from its recent lows.
This week, for Under the Microscope, we draw our attention to star growth stock Deterra Royalties. Although it is classified as a resources stock, unlike traditional mining companies, the business generates revenue through royalties received on specific mining projects. So investors can achieve returns from the strength in the commodity price, such as iron ore, without incurring the operating expenses and also the future capital requirements.
That's a good point, Ken, and you can see why that the return on invested capital is so high at over 500%. Deterra's revenue is generated from a 1.2% royalty fee on all realized iron ore sales. This revenue structure ensures the group has minimal expenses, and this helps maintain both a healthy return on invested capital and also strong net profit margins as well.
Yeah, and in addition to being a growth stock, we have also initiated Deterra as a star income stock because its gross dividend yield is over 9%. But investors may be wondering whether this is sustainable since the expected free cash flow of 26 cents per share is below forecast dividends of 31 cents per share. Furthermore, under Golden Rule 2, the payout ratio is above 100%.
Some investors may be a little bit concerned about a payout over 100%, but we think this is a temporary shortfall that can be covered by the company's ample cash balance of $29 million. Therefore, we feel the dividend is sustainable in the short to medium term. However, we do remind investors that earnings for this stock is more uncertain than your traditional defensive income stocks because it is based on movements in the iron ore price. As such, it is appropriate for income investors to have a short investment time horizon for this stock and also monitor any movements in the iron ore price.
Yeah, and for resource-related stocks like this, you can track the stock's earnings revisions under Golden Rule 3 to help you understand whether analysts have been upgrading or downgrading their iron ore assumptions. Fortunately, the stock is widely covered, with 11 analysts providing consensus estimates. Along the topic of risk management and Golden Rule 1, financial health, an interesting question raised by a member this week is, how does our financial health model differ from others in the marketplace? Well, our financial health model has been backed by academic rigor, developed by Tim's father, Dr. Merv Lincoln, and is the only one that has been back tested with a 96% success rate in helping our investors avoid corporate failure.
Many investors think that the financial health rating is simply a collection of a company having too much debt or not enough cash flows. These factors can significantly weaken a company's financial health, but it's not really that simple.
That's right, Jace. Our financial health model takes into account a combination of balance sheet, cash flow, and profit factors in order to formulate a rating. Aside from assessing debt and cash flow, these factors look at other things, including the level of intangibles on the balance sheet, the change in cash balances, amount of liquid assets, the working capital, and also short-term commitments.
Yeah, so there are a lot of nuances that we take into account. So, for example, if we look at company data 3, the company has very little debt, it's got strong earnings, cash flows, but yet it's in early warning. A closer look of its balance sheet points to a rather extended capital position. For instance, the company's cash at bank of 65 million is just enough to cover its current and long-term debts of 27 million, but it's also got a large accounts payable balance of 185 million. Accounts payable can be thought of as credit. You obtain an asset or services now, but pay for it later.
Yes, and an increase in accounts payable artificially inflates the short-term cash at the bank, but
Mm.
this would unwind when the payments fall due. Therefore, it's not as simple as looking for companies with a net cash balance and thinking that they are not exposed to leverage risks.
Yeah, good point. We can also look at this on the other end of the spectrum. For example, online beauty retailer Adore Beauty Group. The company had a satisfactory financial health rating, even though it's not actually generating much profit or cash flows. And this is because its balance sheet is in a much stronger situation with ample cash balance and retained profits, which allows it to offset some of the liabilities like accounts payable, despite having weak cash flows.
That said, Jason, in most cases, though, companies with little to no earnings and cash flows usually have high risk because they need cash injections or through either equity raisings or debt finance to maintain operations. So financial health really helps the investors to peel back the layers to really understand a company's true solvency position. Okay, that's all we have time for today. Thanks, Jace, again for your insights.
Thanks for having me, Kien, and don't eat too much chocolates.
Oh, I'll remember that. But just to remind our members that Tim will be unavailable for the Lincoln Live event on Monday. However, I'll be there along with our Stock Doctor tech expert, Rob Manfrey, to answer your questions on stocks, the market, and also Stock Doctor. Also, there will be no Taking Stock video next week due to the Easter break. So the key takeaway from our video today is, with debt costs expected to rise and government support measures winding down, it is crucial that we use financial health to help us manage the idiosyncratic risks within our portfolio. In the meantime, we hope you all have a wonderful Easter break from wherever you are in Australia. Take care and have a happy, healthy, and prosperous week, everyone.